Okay, good afternoon everybody. I'm Mike Keating, and on behalf of the MGAA, I'd like to welcome you to our market briefing this afternoon, which has been presented by the Financial Services Compensation Scheme. As always, before I introduce our speakers, a few housekeeping points. Please ensure that your microphone and camera is off. If you'd like to ask a question, and I hope there'll be many on this particular presentation, then please use the chat button at the bottom of the screen, and we'll look to get through as many of those as we can at the end of the presentation. And those we cannot answer, we're committed we'll do an FAQ and send it around, some point in the next week or so. Also, please take time to respond to our feedback survey. It's very important we understand, how you feel about our webinars, the content, the presentations. Always very useful to get that back from yourselves. Okay, so today's briefing. What we protect, value in this protection, history of failures, lessons learned, and activities to reduce the impact of failure is brought to you by the FSCS. And I'd like to introduce Jimmy Barber, Chief Operating Officer. Jimmy joined FSCS in January 2016 in a critical role, bringing together the delivery of its service to customers and the IT and data architecture which supports that service. Previously, Jimmy has had senior roles at RSA and Capital One. So without further ado, I will hand over to Jimmy.
Thanks, Mike, and thank you everyone for giving up your time this afternoon. Hopefully you'll find this session useful. I've also got a colleague of mine, Martin Greetham, who's going to present a few of the slides this afternoon. Martin is a technical expert in our insurance team, and he's also here to answer any difficult questions that you may ask. Without further ado, we'll move on from the first slide, because that looks nothing like me now. As I've just explained to everyone, the suit hasn't seen the light of day since for nearly a year now, so apologies for that. The aim today is to give you a little bit of a briefing on FSCS and what we do, and hopefully you'll understand the role we play in the insurance industry and how that might interact with you guys. So I'm going to talk a bit about our role and coverage. Martin's going to then talk about some of the failures that we've had over the years and what lessons we learned from those failures. There's a couple of interesting case studies there that have hit headlines, so you may be familiar with some of that, so you'll get some of our perspective on that. And we're then going to talk about the levy and what we do to try and reduce that. A little bit of an update on how COVID's impacted our operations and the future, and then closing off with some stuff on Brexit. Julie, if you could go on to the next slide. So we were set up in 2001 after the FSMA came out in 2000, and we're here to protect customers of financial services firms when things go wrong and their firm has failed. We are independent of the government and the industry. However, we do have really strong links to both, in the sense that the HMT and the FCA and the PRA all have some oversight over our budgets in particular, and also we are funded by the levies that the financial services firms fail. So that's, although we're independent in terms of our decision making and how we deal with the claims, we do have some strong links to both industry and to the government. Okay, Julie, if you could move us on. This is really just to show the range of what we cover. Historically, and I think we're best known for the role we played in the last financial crisis, where we bailed out some of the banks, particularly well known for the Icelandic banks and the work we did around Bradford and Bingley. But nowadays, to be perfectly honest, that is a small portion of what we do. So the kind of deposits and banks is about 3% of the total claims that we handle each year. It's a tiny amount of credit unions that sometimes fail that we deal with. Most of the work that we do is really in the advice space and in the insurance space. So in terms of the work we do in advice, we cover people's pensions and investments. So this is, and I'll go into this in a little bit more detail, this is where firms fail and actually people have been missold pensions. So there's a lot of information out there about some of the issues around defined benefit transfers that people have done. A lot of those where the firm no longer exists fall to us. And in the insurance space, we pay up to 90% of people's claims, or 100% where it's compulsory insurance. And there, our work can include, when a firm fails, it can be paying the claims that the firm has in train. And Martin will show you some of the information that shows that if effectively, we can often be paying claims when firms fail into the next generation, if you like, certainly for many, many years, if not decades afterwards. But also, when the firms fail, they're left with books of policies that we then return premium, unexpired premium, or we transfer those books to new carriers. So that's the work we do in insurance and in investments, but we also cover things like debt management firms and mortgage advice. And we also pay out on payment protection insurance. So this is where firms have failed and we pay out their payment protection insurance claims for, and again, that can be sometimes for many years after firms have failed. If you go on to the next slide, please, Joe. So I think it's important that we talk about the value of our protection, because our role, our mission, if you like, has two aspects to it. It is to provide the compensation service and deal with customers who come to us, but it's also to try and improve trust and confidence in financial services as a result of doing that. And what we found in the research that we've done is that knowledge of FSCS and our protection really does encourage more confident financial behaviours in consumers. So we've seen from our research that actually people will be more confident in the decisions they make. And you can see there, we've just pulled a couple of stats out from the research that we've done, where people are more confident. 81% of people said that they were more confident in their decision making by when they knew that FSCS exists. And also people do feel that at the point they are deciding on products, they should know whether a product is covered or not. And certainly in the investment space, we have found that people will invest more, and they will invest more in their pensions as a result of understanding about our cover. And they do also trust their advisors more as a result of understanding about FSCS. So it's important in terms of not just because people are going to make claims, that is only a small part of how we impact financial services. It's also the fact that the majority of people will, we hope, never use our service, but those people still are more confident in knowing that we exist. If you can skip on, Julia, please. So in terms of the kind of high-level eligibility process, there are certain things that we have to have in place for us to pay a claim. First off, a financial services firm has to fail and be unable to either return money or pay claims themselves. The firm has to be FCA or PRA authorised, and the activity that they're doing has to also be a regulated activity. So sometimes at the fringes of our perimeter, you might find that firms are regulated, but some of the activity isn't. So a good example of this has been the recent failure of London Capital and Finance. LCF hit the headlines and has been throughout its history. And that was a regulated firm, but some of their activities were unregulated. So in those instances, we don't cover them, but where we find regulated activity, then we do. There also has to be a civil liability. And one of the things that is different between us and the Ombudsman Service, as an example, is we have a different bar from the Ombudsman in terms of deciding that we're going to pay a claim, where we actually have to have a evidence of it, that there would be a civil liability there. And the customer has to actually suffer a financial loss as a result of the behaviour of the firm. Now, that isn't just they've lost their investment, because investments are, customers do take a risk. It's whether they were missold or misadvised on that investment, and that is an important point of distinction, where we don't just cover people's investment losses, we cover where they've been missold investments. And actual eligibility is looked at strictly on a case-by-case basis. So we look at the merits of each individual claim. And from the previous slides, you have seen the range of products that we do. Some of those claims can be very, very straightforward, and often we can find ourselves where we're just calculating the return of a premium and returning that to a customer. But some of the claims that we deal with can be real long-tail complex liability claims that are settled over many, many years. If you skip forward, Julia. I'm now going to hand over to Martin, who's going to give you a bit of a history lesson and some of the things that we've been up to over the years.
Yeah, thanks, Jimmy. And yeah, I guess the most straightforward way that we thought of doing this was just to step you through a couple of timelines. The first of which covers things from the inception of what used to be called the Policyholder Protection Board. Now, this was, as you can see, this was brought about in 1975, and it essentially provided the first scheme for compensating certain policyholders of failed insurance companies. And it was administered by the Policyholder Protection Board, the PPB, as I've just mentioned. In common with the current iteration of the FSCS, the Policyholder Protection Board was designed to protect the most vulnerable of insurance policyholders. So its scope was focused on private individuals and small businesses, which continues to this day in terms of what FSCS's protection is geared towards. As you can see from the timeline there, things from 1975 for a good few years, things were pretty quiet. And whoever was tasked with administering the PPB thought this was quite a comfortable little job. That all changed in the late 90s and early 2000s, when three bombshells hit the insurance market in the form of Builders Accident, Chester Street, and Independent. Now, I'm sure a lot of people on this call will have heard of those, be very familiar with those names. Taking the biggest first, just to give you some context. Chester Street, which was formerly known as Iron Trades Holdings. Iron Trades was at one stage the UK's biggest insurer of industrial risks. It covered the UK's heaviest, dirtiest industries, basically, the likes of British Steel, Swan Hunter, Harland and Wolff. All of them were covered by Iron Trades. In 1989, Iron Trades, looked at the prevailing winds in respect of asbestos and APH claims over in the US and so on, and they started moving their pre-90 EL policies into another vehicle called Chester Street Insurance Holdings. And there's a bit of, apparently they named it Chester Street Insurance Holdings because when the head guys at Iron Trades were figuring out what to name it, their offices were based in Belgravia over near Buckingham Palace and overlooking a street called Chester Street. So hence they just picked, they didn't put much thought into the name and went ahead with that. But the impact of it was huge, and obviously FSCS is continuing to deal with lots of asbestos related claims, such as lung cancer, mesothelioma, And we expect to continue to deal with the consequences of Chester Street and indeed Independent and BAI for the next 20 to 50 years. Just to speak a bit on Independent and what a slightly more recent failure, and one that's probably got more well known within the London market and within the city. Independent, or Indy as it's often known as, failed in June 2001, shortly after Chester Street. At the time, it was dubbed one of Britain's worst commercial disasters, and was compared to the Robert Maxwell affair and the collapse of Barings Bank. It also left 600,000 policyholders without insurance cover. A key finding of Independent's downfall was a very loud, bright, some would say ambitious CEO in the was controlled huge aspects, and was really pushing the company to attract new business and take on new business. Unfortunately, behind the scenes, there was also cases of under-reserving and reserve manipulation were widespread amongst the in terms of the claims handling side of things. At the time of the failure, actuaries estimated that Independent was under-reserved by anything between 110 and 250 million. Large losses were kept off computer systems and recorded haphazardly elsewhere. So these three failures hit, as you can see, in the early 2000s, and the FSCS is continuing to deal with the consequences today. We still have received a steady flow of claims which we're required to protect and pay compensation in respect of today, and obviously the unfortunate people who work in these industries who've contracted these horrible diseases, fortunately are able to receive some kind of compensation for the pain and suffering that they've undergone. So if you could just kick it on to the next slide, please, Julia. Thank you. So this timeline is a more recent timeline. It covers the past 5 years, as you can see. So as you can see, we've got in the past 5 years, we've seen the failure of very much a different theme to what we've just spoken about there. Past 5 years alone have seen the failure of 10 insurers who operated in the UK via EU passporting rights. In total, FSCS has now dealt with the failure of 16 passporting insurers, which has come at a cost of around 372 million in terms of FSCS compensation spend. Some of the, all of the insurers we've dealt with up to date are detailed on, in the past 5 years, are detailed on that slide there. And it also, we've provided some idea of where the firm, a clear idea of where the firm was based. As you can see, a lot of firms have based in Gibraltar. We've had a couple of Danish firms in Kudos and Alpha. We've even had one based out of Liechtenstein, by way of Gable. A common theme with these, a lot of these more recent EU passporting failures is that the firm's business functions are comprehensively outsourced. The company is run with a skeletal staff from a small headquarters. In the case of Gable, it transpired that the firm was essentially being run from a ski chalet rented from the Prince of Liechtenstein, and with a very a small staff in there, keeping track of the various bordereau coming in and reporting coming in from its UK agents and agents elsewhere. The firm's cover holders are often incentivized to take a cut of the premiums they write. So there's every motivation for them to write a lot of business, but very little motivation for them to write good quality business, which obviously impacts on the firm's viability downstream. There is also often, we find, an over-reliance on reinsurance, and obviously that model can work very well, but it falls apart when the reinsurer refuses or is unable to pay, as in the case of CBL Reinsurance, which was based out of New Zealand, and who Gable and Alpha and Kudos as well, I believe, were heavily reinsured with. The firms are also 9.5 times out of 10 unrated, so that they don't have an S&P or an S&P rating, for example. Often the firm's senior management claim that independent ratings are overrated, excuse the phrase. But I think from our experience, as soon as somebody within their senior exec starts saying things like that, red flags and alarm bells start ringing. And another common theme is that they're set up in unusual, apart from Gibraltar, which obviously is a well-established market, but they're often set up in unusual places. Again, referencing Gable and Liechtenstein, which is not a well-known insurance hub by any means, and we found that firms who are looking to, for lack of a better phrase, looking to maybe make a quick turnaround, make some quick money, and enter the market, undercut it, pull in a lot of premium, they're attracted to those less regulated, less sophisticated regulatory environments, such as Liechtenstein. So yeah, as you can see, considering compared to the opening stages of the PPB on the previous slide, the past 5 years there's been a lot going on in the insurance failure space, which we've had to deal with. So, thanks, Julia. Could you just kick it on to the next slide? Which brings us to our most recent, one of our most recent failures. So this is in reference to East West Insurance Company. I appreciate I've just been talking to you about passporting insurers coming in from Gibraltar, Denmark, and or Iceland, but East West was actually a UK-based insurer, and it's ultimately owned elsewhere. It's ultimately owned out by a firm in Bermuda. But it's to all intents and purposes is a UK authorised insurance company, as we've got there. In October 2020, we declared the firm, and this was a key. It was a big step for us, because we'd had been tracking the firm's difficulties for some time, and we'd been working with the FCA, the PRA, the Bermudan Monetary Authority, and other stakeholders to try and stave off that insolvency and keep it on a solvent footing, but that wasn't found to be possible. And in October 2020, we declared East West insolvent. Why did it end up in an insolvent position. Essentially, you need to go back to 2018 when East West acquired a book of 10-year building guarantee policies from Zurich. Zurich was writing this business from 2003 to 2009, and they since 2009 they'd been managing the runoff within their legacy arm. Unfortunately, as I'm sure everybody on the call is aware, by the time East West concluded on the purchase of the portfolio, the Grenfell disaster had happened. June 2017, the Grenfell Tower fire breaks out, and as a result of that, that led to a material increase in claims costs due to issues arising from reviews of buildings with dangerous cladding on them, and the requirement to replace unsafe cladding and other address other fire safety issues within those buildings. And clearly that was completely changed the whole landscape in relation to handling, in relation to East West dealing with this book. We've and when the firm went into administration in October 2020, FSCS was in the frame to help residents of those high-rise residential buildings where fire safety issues have been identified. And a key challenge for us now is to ensure that fire safety remediation work continues, and we're working with as we've got there, we're working with Ernst & Young, where the joint administrators have been appointed from. We're working with Armour Risk, who are currently administering the claims, and various other experts and surveyors to make sure that this work continues at pace, so that people are living living safely in their homes. Just to flag some of the key issues which we're currently tracking in relation to this. A common theme, which I'm sure you might have heard from previous talks with FSCS, it transpires that the firm has limited underwriting and claims records. East West inherited, the underwriting and claims records it pulled over were not in a good state. The identity of buildings and developments which they insured isn't clear without significant investigatory work being carried out. As already I've touched on, in terms of the claims handling post Grenfell, the claims are very expensive to investigate and handle. Due to East West's limited resources from the off, they found it very difficult to progress or fully investigate the outstanding claims they had on their book. And again, bringing to the central issue, the key issue, which should be front and center, the impact on the customers, on East West's customers, on its policyholders. Many of the buildings covered by an East West building guarantee are high-rise residential buildings with cladding related fire safety issues. The cost of carrying out those repairs to fix those cladding issues, as you'll see from all the news currently, it's often passed from the freehold to the individual freeholders to the individual leaseholders, and they're facing hikes in their service charges. In the meantime, leaseholders are trapped while they're trying to remortgage or sell these properties. So it's really a big lot of challenges that we're facing on that. Julie, you want to kick it onto the next slide? I'll quickly go over alpha, because I appreciate you probably don't want to drive you to distraction by going over my tales of woe. But as we have already touched, Alpha Insurance was a Danish insurance firm. It sold a variety. It was an unrated Danish insurer. FSCS declared the default in 2018. Sold a range of insurance policies in the UK: motor, solicitors, solicitors professional indemnity. Also, unfortunately, 10-year building guarantees as well. We had a lot of issues on Alpha dealing with. They had a significant taxi book, so there was a big stumbling hurdle at the first on day one of dealing with the failure was taxi drivers in the UK had received text messages from their brokers, understandably saying, your insurer's failed, you need to get replacement cover. So there was a lot of we needed to act quickly to try and help those the tens of thousands of taxi policyholders that they had. Another key problem for us was securing transfer of cover for all the existing policyholders. In some cases, this was more straightforward, where the data was good. In other cases, it was not straightforward, such as its 10-year building guarantees, which, for obvious reasons we've just gone over, were very difficult to find another home for. So it was really impacted by the limited data again that we had from the firm, and the mixed communication that went out at the outset of the firm's failure, which left put a lot of taxi drivers in very difficult positions while they were trying to figure out what to do, next steps to take in relation to their livelihoods. So yeah, and I'll stop there because I appreciate Jimmy's still got a few bits to cover off. But as you said, any questions at the end or subsequently, please shout.
Thanks, Martin. And I think that's a good in-depth summary of some of the work that we've done in the past and some of the issues that we faced in terms of paying out claims. Quite often we'll find ourselves in a situation where a firm fails and we're keen to protect people and keep them get their lives back on track as quickly as possible, but due to issues around data, it can take a good while to get clear data that enable us to pay out people. If we can flick onto the next slide, please, Gio. Our levy, as I mentioned, is paid for by all the different industries that we protect their customers, and it has been increasing at an alarming rate in recent years. And our predicted levy for next year is just over £1 billion now, which is a significant increase over recent years. And it does mean that insurers will be paying more than they have in previous years. And that's driven by two things. One, it's the payouts for all of the failures that Martin's just talked about, of which some of them are quite new, and others, it's a long tail business that we're paying out. So it is seeing that increase in failures, but also we've seen a rise in complex SIP and pension advice claims. And what we have, the way our levy works is each class has a limit to how much they can pay, and then it tips into what's called the retail pool, which means that both our investment class and our SIP, the class that covers SIP operators, both of those have hit their caps, and therefore the increases in those categories is picked up by the retail pool, which means that all the other product classes share that. So the financial impact on firms of this is kind of significant, and it's not without kind of note from us in terms of what do we think about and how do we deal with it. So I'm going to talk through a couple of things that we're doing to try and manage the impact of the levy. If you flick forward to the next slide, Julia. We had introduced into our strategy for the 2020s our prevent pillar. Previously we were focused on just being prepared and able to pay claims, but into the 2020s, we really think that we have to work closely with regulators and industry to try and stamp out bad practices, which can lead to both consumer detriment and also the increased levy. Because I think it's important to remember that for every pound that we pay out, both we're very conscious of the fact that the industry has to pay for it, but also that there's a customer at the end of that has had something bad happen to them. A good example of where we've worked using our data and collaborated with the regulators is in phoenixing. And this is a practice that we're working with the regulators to try and stamp out. And it's where advisors give bad advice and then their firm goes bust. And then they set up a claims management company and then pick up those customers they've just misadvised and charge them a fee for helping them get their money back from FSCS. And that's something that we spotted in our data as a practice, and we've been working with the FCA to try and stamp that out. We also see, we have seen over the last couple of years an increase in the number of scams, and we are working to try and reduce that. And we've just recently signed an understanding with the Serious Fraud Office to try and help use our data in prosecutions for fraud as well. The next slide, Julia, covers the work we do on recovery. So when an estate fails, we are often the major creditor in that estate. So we make sure that we get as much money back as we possibly can on behalf of the levy payers. And as an example, we got back £20 billion from the failed banking estates in 2008. But more relevant for this audience is that we do also recover against the insurance estates, and in the last few years we've got over £100 million back from the failed insurers that we've dealt with in the past. If you can go forward, please, Julia. We just want to talk very briefly about the impact of the recent pandemic on us, and we have, like a lot of you, adopted new ways of working. And the work that we've done previously on making sure that we're resilient and able to deal with whatever is thrown at us has really paid dividends. And our teams, using the technology that we've invested in, have really stepped up to the plate in the last year. So in the last 6 months, our customer satisfaction has been the highest it's ever been, and significantly higher than pre-pandemic. And we have made out some significant payments across the board, including £64 million paid out to insurance companies. But we have been managing the well-being of our staff, so we've been making sure that we take care of people. I know, like a lot of you, you're feeling the kind of Zoom and Teams fatigue, so we do make sure that our well-being of our staff is paramount throughout the time that we've worked. And now, in terms of the impact, we are looking at what the future holds in terms of any economic downturn and what that might do to the insurance industry, and therefore what that might do to future claims. If you can flick forward to the next slide, Gio. At the same time as the pandemic, obviously we've had Brexit, and what that means for us is that firms have had the opportunity to opt into the temporary permission regime, which means that now there's not passported firms, they are in the TPR, which will last for up to 3 years. And firms have had to talk to the UK regulators to enter the TPR, and in the longer term will have to decide and be authorised within the kind of UK. So while we're going through that transition, FSCS coverage does still apply in the TPR. If you can move forward, please. There's a couple of things that it's kind of worth mentioning in terms of how we work and would like to continue to work closely with the MGA and the insurance industry. One of the things that has hampered us through all of the failures that we've dealt with has been the need for better data, and that's really held up our ability to understand who the customers are or how much money they are due. We also work closely in terms of sharing information, and we have a regular panel with the insurance industry where we share information about what we're doing, what we've got coming up, but also it's a two-way communication, so we get information back in terms of you know, what intelligence you guys might have about what might hit us in the future or possible trends. Because bear in mind that we're running a number of insurance estates, as you can see from the stuff that Martin talked through. All of those insurance estates that are in runoff are under our oversight. So we are interested in trends, whether that's how claims are being handled or the impact of changes like the Ogden rules and stuff like that. That all impacts our insurance estates, and so that's all relevant for us. Equally, you may see things and trends that happen that we keep an eye on that might mean that certain things fall to FSCS in the future. I think there's also an opportunity around consumer awareness. Recently, a survey that we did showed that only 17% of insurance customers understand that they are protected by FSCS. And if you bear in mind the difference it makes to them in terms of their confidence and their trust in financial services, and also their view of their advisors and how they trust their advisors, we think that's a real win-win in terms of building awareness. So there are things that we think that we can also do in the future to work together. So that concludes kind of the presentation. Mike, I think it's over to you for questions.
Yeah, first of all, Jimmy and Martin, thanks very much for that very informative presentation. I think without doubt it's sort of certainly highlighted in much greater detail in terms of what the FSCS does. We've not had any particular questions coming through, but if I can kick off, I sort of attended the plan and budget, which I know Jimmy's sort of aware of. And Jimmy, in particular regarding the general insurance levy, where there was an increase, I believe you sort of talked around 3 areas, and I just wondered if you could just go through those 3 areas again. Now, my understanding was one is that there was an anticipation that insurers passporting into the UK would continue to fail. The second one was the long tail impact of people like Elite and East and West. And the third was actually the legacy issues around the older failures. Could you just sort of expand on those 3 things in terms of how they've driven, you know, the increase in the sort of levy for next year's budget?
Yeah, and I think it's worth saying, Mike, we are constantly reforecasting that budget. So every month we look at the latest intel. We work really closely with the FCA and the PRA around what their economic analysis, both in terms of kind of insurers and their jurisdiction and the markets in general. And those are regular conversations. So I would fully expect that over the next few months, those numbers will continue to change as we refine our estimates. But at the moment, as you rightly say, our estimates are built up by those kind of some of the long tail stuff that we're dealing with. And we can see pretty stable trends in those. So they're relatively easy to predict. We've then got within our numbers kind of estimates from the newer estates, and that can be a lot more difficult to predict. So, you know, things like, as you say, East, West and Elite as 2 that failed recently. When you're talking about the quality of data that we've seen in every insurance failure that we've dealt with, the estimates can be quite difficult to work out. As Martin touched on, quite often the insurers have under-reserved, and so, you know, we have to go in and work with the insolvency practitioners and really refine those numbers. Now that can lead naturally to an amount of volatility within those numbers. And then thirdly, we look at what might be coming down the train, the track at us. So in other words, what might we see? And that's where we thought that the likely trends were that a number of these, the firms that are now in the TPR might still fail. And that's a trend that we've seen consistently over the last 3 years. So they're the 3 blocks that our numbers are made up on. And we will continue to kind of refine that on the basis that, you know, we'll get better estimates. And I know that we've got, you know, our arms around the kind of East-West numbers better now than we had when we put the plan and budget together. I think the other thing to mention and this is part of the reason why we constantly reforecast, is that our budgeting cycle, like a lot of yours, is quite lengthy. So some of the estimates that were put in for our numbers were put in last summer, and the world's moved on massively since then. So we're looking at all of these factors, and we'll continue to refine those numbers before the bills go out this summer.
Okay, thank you. So we have a question. We do have a question actually. So so what is the rough compensation split between financial advisors and SIP operators, say over the last 5 years, compared with insurance brokers and MGAs? So just hold that thought at the moment. Then there's a second element. So noting financial advisors and SIP operators reach their limit, are there alternative options than to keep increasing the top-up levy on the retail pool insurance broker market? Could FCA fines collected be used instead? Or to up the levy on the offending market, i.e. financial advisors and SIP operators, instead of increasing the levy for brokers and MGAs? I think this is the case of that where MGAs, are operating within a financial model with their capacity partners. Obviously, an increase in levy would be felt through some transfer of expense to sort of MGAs. So, I suppose it's a case, can you ring fence, and apply the sort of increase to those who are offending the most?
Yeah, and just to pick up on a couple of points in there, I think as alluded to in the question, the FCA set the rules for FSCS funding, and they have had recently a call for input into those rules. So they did consult a couple of years ago on those rules, but with, I think, the kind of rising numbers that we've seen, they've gone out recently for a call for input. And I know that we and a number of other firms, trade bodies, had also input into that. And one of the questions that no doubt will be looked at is how the levy is split across different product classes, and things like the use of fines and stuff like that. So I know all that sort of stuff will no doubt have been input into that. We're sort of very conscious of the impacts that we our levy has, which is part of the reason why we're looking at the prevent agenda, because in the ideal world we would be working to reduce the number of claims, reduce the consumer detriment, and reduce the levy overall, aside from how is it split and how does it get moved about. So I think we need to focus on how do we reduce the size of the overall pie, and then how does that split work as well. In terms of the SIP operators versus pensions and investments versus insurance brokers and MGAs, I would have to go back and look at the numbers, but I would fully expect that those numbers would tell us that we've seen a rising tide in pension claims, complex pension claims, and SIP operator failures over the last 3 years, and they would be far more significant than the any issues created by insurance brokers or MGAs for sure. I haven't got the exact figures with me, Mike, but that would be what the trend would definitely tell us.
Okay, thank you. Probably another one from me really, and it's probably more, Jimmy, around your prevention pillar. Where do you see the inhibitors to actually making that a resounding success?
I think one of the challenges that we're facing at the moment, I think it's quite a complex. Well, there's a couple of things I'll probably put out. Mike, it's quite a complex problem to solve. It isn't like pull one lever and it'll be easily fixed. So I think the solutions are likely to be complex, and they need lots of players to get involved. So I think it's a combination of us, the regulators and industry working in collaboration on what is a complex problem to solve. And like I say, I don't think there's any one single silver bullet that's suddenly going to change that. I think the other thing that that is really at play is that there are really good intentions here, and I think everyone wants to see the same outcomes, but we are dealing with kind of the sins of the past, if you like. So the stuff that we're dealing with today, as we showed, even in the insurance space, you know, it's from a generation ago, and so therefore, you know, even some of the things that we might do today, they won't necessarily be seen in our numbers quite, you know, as immediately as we might like. But I don't think that should put us off from still, you know, thinking about what's going to happen in future years and then working together on what are those solutions. I think the good thing, you know, the prevent pillar in our strategy has been really widely, you know, recognised, and the reaction's been really positive about us saying that, you know, we really need to work together on that. I think it's now the need for, you know, us, the regulators and industry to drive that through to some clear actions that will then change the numbers over the future years.
And would you see a measure of success that, you know, could I phrase it, that it's not inevitable that the levy will continue to rise?
I think ultimately that's where we would like to get to. I think it's a complex picture in terms of, you know, when that might be, just because of, like I say, I think the solutions won't necessarily be solutions that are like light switches that suddenly change the numbers, because we are dealing, say, with some of the past behaviours, and that will still try and will still flow through. But I do think that, yes, ultimately that's where we would like to get to.
Okay, well, I don't think we've got any more questions. I'll just ask everyone who's currently still attending if there's any last questions you'd like to ask Jimmy or Martin before we close. No, we look like we're all fine. So once again, on behalf of sort of the MGAA, Jimmy and Martin, thank you very, very much for that very informative and sort of detailed presentation. As I said, it certainly is really sort of showcased in terms of what the FSCS does, and I agree with all your sentiments that, you know, the more the industries can collaborate to support your sort of prevention pillar, then that leads to better outcomes for everyone in the insurance distribution sort of chain. So again, thanks very much indeed.
Thank you for inviting us, Mike, and thank you for everyone for your time.
Thank you. Thank you. Thank you all.